I had two business owners call me within an hour of each other. Both of them needed $300,000 to expand their operations. Both had similar credit scores and cash flow. But when I looked at their situations, I recommended SBA financing for one of them and conventional bank financing for the other. 6 weeks later, one got approved at 9.5% with 10% down, and the other got approved at 6.2% APR with 20% down. Same loan amount, similar businesses, completely different recommendations. Why? Because the best loan isn't always the one with the lowest interest rate. It's the loan that fits your specific situation, your cash flow needs, and your long-term business strategy. In this video today, I'm gonna break down the real differences between SBA and conventional financing, when each one makes sense, and how to know which path is right for your business. This is the comparison I wish someone had shown me when I first started helping businesses get funded. The fundamental difference. The biggest difference between SBA and conventional loans isn't the interest rate or the terms. It's the risk tolerance. With a conventional loan, the bank is taking 100% of the risk. If you don't pay, they lose all their money. With an SBA-backed loan, the government is backing 75 to 90% of the loan. So the bank's risk is significantly reduced. That difference in risk changes everything else. It changes who qualifies, what terms you can get, how much you can borrow, and how long the process takes. Understanding this fundamental difference helps you understand why certain businesses fit better with one program versus the other. SBA loans. When government backing works in your favor. SBA loans are designed for businesses that might not qualify for conventional financing or that need better terms than conventional financing offers. The government backing allows lenders to approve deals they might otherwise decline and offer terms they might not otherwise provide, such as higher funding amounts and longer terms. The biggest advantages of SBA financing are lower down payments, higher loan amounts, and longer terms. Where conventional loans might require 15 to 30% down, SBA loans typically only require 0 to 15% down tops. Where conventional loans might offer 5 to 15-year terms, SBA loans can go anywhere from 10 to 25-year terms for real estate. SBA loans also work well for businesses that are newer, growing rapidly, or in industries that banks consider a high risk. The qualification requirements for SBA loans are often a lot more flexible. Banks might require 2 years of profitability for conventional loans, but would accept 1 year of profitability for SBA loans. Personal credit requirements might be at least 700 for conventional loans, but 640 minimum for SBA loans. Now, conventional loans. When banks compete for your business, conventional loans work best for businesses that banks really want as customers. If you have strong credit, consistent profitability, high average daily balances in your business checking account, low debt ratios, and operate in a stable industry, banks will compete for your business with their conventional financing programs. The advantages of conventional loans are speed, flexibility, and sometimes better rates. Conventional loans can close in 20 days instead of 60 days. Banks can structure terms more creatively because they're not bound by SBA guidelines. And for the strongest borrowers, conventional rates can be lower than SBA rates because the banks can set whatever rate they want. If they're earning a large depository account by getting your business through this program, they're gonna be way more reasonable with their terms. Conventional loans also have fewer restrictions on how you can use the money. SBA loans have specific rules about what qualifies as an eligible use of funds. Conventional loans give you a little bit more flexibility to use the capital however your business needs it, as long as you pass all the quarterly and annual checks that they do. The personal guarantee requirements for conventional loans are often smaller than SBA loans too. While you'll still guarantee the debt, banks might cap the guarantee or release it sooner with conventional financing. The hidden costs and benefits. When comparing SBA and conventional loans, most business owners look at interest rates, but there are other costs and benefits that matter just as much. SBA loans come with guarantee fees that conventional loans just don't have. These fees typically range from 2 to 3.5% of the loan amount, depending on the size and the term. That's real money that gets added to your total costs. But SBA loans often allow you to finance more of the project costs, which can offset the guarantee fees. If a conventional loan, for example, requires 25% down, and an SBA loan requires 10% down, the SBA loan might cost less upfront, even with the guarantee fee. Conventional loans often have faster prepayment options without penalties as well. SBA loans typically have prepayment penalties for the first few years, 3 to 5 years typically. The approval odds calculation. Getting declined for financing costs time, money, and sometimes credit inquiries that make future applications harder. I need to be completely transparent about something and slow my roll a little bit. Both SBA and conventional loans can be incredibly difficult to qualify for. Conventional loans more so though. The reality is that most small business owners simply don't meet the strict requirements that banks are looking for when it comes to conventional non-SBA backed lending. We're talking about businesses that typically need 5+ years in operation, personal credit scores of 720 or higher, excellent business credit, 6 or 7 figures in net profit, not gross revenue, but actual profit, year-over-year growth trends, and most importantly, they need to usually have solid collateral to qualify for significant conventional bank financing. If you're a borderline borrower who doesn't check all those boxes yet, SBA financing gives you much better approval odds than conventional. Banks will decline conventional financing applications they might approve with SBA backing. But let's be real here. Even SBA loans are tough for most small businesses to qualify for. The question then becomes, is it better to apply for conventional financing with a 30% approval chance or SBA financing with a 70% approval chance? For super strong borrowers who meet all those qualifications that I mentioned, conventional financing might have a 90% approval chance. Conventional financing often makes more sense because the approval risk is minimal. But if you're like most small business owners, working hard, generating revenue, but maybe you don't have perfect credit or years of documented profit, or you're in a newer business, understand that both paths can be challenging. That's exactly why we work with 20 different funding programs, because traditional financing isn't the only option out there. The timing factor. Timing matters more than most borrowers realize. If you need capital quickly and you qualify, conventional financing wins. Banks can approve and fund conventional loans in 2 to 4 weeks. Just last week, I got somebody approved for a $250,000 line of credit with interest-only payments that's going to be funding on Monday. That's at an interest rate of prime +1. But that borrower was extremely qualified, and the banker was able to meet them in person within the same week. And we like to move fast as Small Biz Heroes. Banks can usually approve and fund conventional loans in 2 to 4 weeks. SBA loans typically take 45 to 90 days. Sometimes SBA loans can be under 30 days though. It depends on the program and the situation. Every deal is different. If timing isn't critical, SBA loans often provide better long-term value through lower down payments, higher approval amounts, and longer terms. The extra time up front can save you thousands of dollars per month in payments. But like I said, there's lots of different programs and every single situation is different. Let's talk about some more real client examples. Let me tell you about those two businesses I mentioned in the beginning of this video. The first was a medical practice buying equipment, strong cash flow, excellent credit, stable industry. They qualified easily for conventional financing at prime plus 1%, closed in 30 days, and got exactly what they needed. The second was a quickly growing e-commerce business buying a warehouse. Good business, decent credit, but only had 18 months of profitability, and they were growing rapidly. Rapid growth that made conventional lenders nervous. SBA-backed financing gave them longer terms that really helped their cash flow at the time, and approval odds that conventional financing simply couldn't match because of their rapid growth that scared away the conventional lenders. Similar loan amounts, but completely different risk profiles and timing needs. The medical practice optimized for speed and cost. The e-commerce business optimized for qualification, approval odds, and cash flow. How to choose. Here's how I evaluate which option makes sense for each business. First, qualification likelihood. If you're not confident about conventional approval, start with SBA-backed financing. Getting declined slows everything down and lowers your optimism. Second, cash flow impact. Calculate total monthly payments under both scenarios. Sometimes the longer SBA terms matter more than the interest rate difference because remember, the longer the term, the lower the payment. Third, timing requirements. If you need money faster, conventional financing is probably your best option. If you have a couple months, SBA might provide better terms. Fourth, future flexibility. Consider how each option affects your future borrowing capacity. SBA loans might limit future SBA borrowing, but conventional loans might preserve SBA eligibility for future projects. The hybrid strategy. Sometimes the best approach is using both programs strategically. We do that at Small Biz Heroes all the time. You might use conventional financing for immediate needs and SBA financing for longer-term projects. Or start with SBA financing to establish banking relationships and graduate to conventional financing as your business strengthens. The key is thinking about financing as a long-term strategy, not just solving today's capital need. The best loan isn't always the cheapest loan. It's the loan that fits your situation, gets you approved quickly if you need it to be approved quickly, and supports your specific business strategy. Both SBA and conventional financing have advantages depending on your specific circumstances. If you're trying to figure out which option makes sense for your business, that's exactly the kind of analysis we do every day. We can review your specific situation, evaluate your qualification likelihood for both programs, and show you the real total cost of each option. The consultation is free, and you'll walk away knowing exactly which path gives you the best combination of approval odds, terms, and total costs. Call us at 888-859-8408. And be sure to subscribe so you don't miss another video, and I'll see you in the next one.